Ladies and gentlemen, welcome back to the channel. AMC Stock, we're going to talk about it here in this video. Really, most of this video, though, is going to be about what to expect this week. Because holy moly, if you did not see one of the last videos put out, specifically the one with Evil Jerome Powell in the thumbnail, I think you should probably watch that one as well. But here in this video, I'm going to give you a rundown of all of the major events coming over the next 72 hours or so. And yeah, it's going to be a little bit of a shit show for this week. I think that's the easiest kind of conclusion that we could draw here. Now, there's really three major events this week, one of which is on Monday, so tomorrow, the GTC conference with Nvidia. I will explain briefly why this can be so important for our markets, but I don't think it's the most important catalyst. Second catalyst is on Tuesday at about 11 p.m. The Bank of Japan is going to raise rates for the first time in 17 years. There's $4 trillion of Japanese money that is held in foreign accounts, foreign money markets that are held in treasury bonds. And there's some fear out there on Wall Street that maybe this raising of rates on Tuesday could draw some money from our markets and take it back to Japan. And that could be a little bit problematic. And then, well, the number one catalyst of all is Fed Jerome Powell and the epic rug pull that we are likely to receive. Now, I don't say this because I know I'm going to be correct. I say this because I'm not afraid to be wrong. And I think there's a difference here. You got to take all information, all opinions with a grain of salt and come to your own conclusions. This is not financial advice. This is not a recommendation to buy, sell, trade any stock, security, crypto option. Does not matter. Derivatives, go crazy if you want to. I'm not going to tell you to because I am not a financial advisor. But do what you do. Do with what this information, do what you will with this information. Do what you please, okay? So let's get started with event number one. It's the Nvidia GTC conference. Now, normally I wouldn't say a single stock's conference or event would be important, but look at Nvidia's chart. Nvidia's chart is when parabolic. Nvidia has contributed alone over 2% of the year-to-date gain in the S&P 500, okay? Nvidia has went from like less than 1% of the index of the S&P to over 5%. Nvidia has, yes, carried the way of the markets. There's nobody that's going to argue that. Now, what you've seen since last earnings has likely been a buy the rumor kind of scenario. Buy the rumor of this GTC conference. Dude, listen to this. There's 80 to 100,000 people going to a nerd convention. I'm a nerd. I want to go to Nvidia's GTC conference. There's 80 to 100,000 nerds in the US, like myself, that want to go to this conference. That is a hyped up event. That is more than an NFL football game. Okay? That's insane. Okay? That's ridiculous. Okay. With that said, I think you have to look at Cisco. Cisco, as I explained in the last video, Cisco went parabolic during the dot-com bubble. You had to own Cisco. You had to, or you were going to lose clients. For many of the same reasons Cisco went parabolic is many of the same reasons why Nvidia is going parabolic. Cisco at the time was starting to bring in, some EPS. At the time, Cisco was going to bring in about 50 cents of EPS for the year 2000. And now they're at $3 of EPS. That's a six-fold, 600% increase. And the stock is still not back to all-time highs. That's because during this parabolic rally, when Cisco basically went from a $2 stock back in 95 to a, $60 stock, $56 stock or so, you pulled forward like 25 years of returns in this one move that lasted, call it 5 years, really like 2 years. From 98 to 2000 was the majority of the Cisco move. But a lot of the same parallels could be true for Nvidia. We just don't know how much demand has been pulled forward. If demand continues to be off the chain for a long time, great. But inevitably, Nvidia may follow the same chart as Cisco. Maybe it's not 25 years, okay? But there will be a period of time where Nvidia will fall and then Nvidia will not hit new all-time highs for a while. Does that happen now? I don't know. Does Nvidia go to 1,500? I don't know. But if you look at this on a market cap basis, Nvidia is almost a $2 trillion company. If there's anything that is unexciting to investors coming on Monday, the stock's going to get destroyed, okay? And maybe even if there is exciting news, maybe the stock just gets sold off because buy the rumor, sell the news. That's a pretty relative safe strategy that a lot of traders employ, and that's why that phenomena occurs in the first place. So coming tomorrow, that would not surprise me if Nvidia does start to sell off due to the 5% market weighting Nvidia has in the S&P, more than that in the NASDAQ. That could be a little problematic. Now, we also had Adobe. They had earnings. Broadcom, Marvell, all these other stocks had earnings, and they fell, right? They did not give us AI numbers. Like, the guidance was pretty underwhelming from all of those companies. Broadcom was the only one with decent numbers, but they still gave you a slight guide down, kind of met expectations, which is a disappointment anyways when you are an AI stock or a semiconductor. So you could have a negative effect on those related just semiconductor companies in general, but also your other AI stocks that are deemed as not GPU providers, but like a Microsoft, or even a Apple or Google, or some of these other guys that maybe have benefited a little bit from the AI wave that has hit the market. So those stocks could also be in trouble. And again, they are the largest market weightings in the markets or in the indexes. So that could be quite problematic, at least on Monday. Now, for Tuesday, this is a little bit more of a wild card. I will say it could do nothing, or it could be a huge event that causes the markets to crash. We just really don't know. And this is technically going to happen Monday at 11 p.m., but stocks are going to really trade on this coming in pre-market or futures, pre-market, and then coming on Tuesday. Now, it's the Bank of Japan interest rate decision. They're expected to raise rates from negative 0.1% where they are now, to bring that up to 0% to 0.1%, to actually go positive again. That would be the first time in 17 years that the Bank of Japan has raised rates. Now, this article says Japan's $4 trillion offshore funds will ignore the first BOJ rate hike. We don't know that. Now, when you actually look at the survey, it's like, are you sure? Are you positive? Okay. It says only about 40% of 273 respondents said the first interest rate hike by the Bank of Japan since 2007 will prompt the nation's investors to sell foreign assets and reappropriate the proceeds back home. Only 40%? Only 40%. So you're basically at a coin toss. People are like, yeah, they may or may not, sell U.S. bonds and take that money back home. If you take a look at TLT, again, I think a lot of you guys became familiar with bonds via the banking crisis, because if you did not pay attention to bonds before, that kind of highlighted it for you, why you needed to pay attention. And that's another potential effect here. Really, the banking crisis happened because the face value of bonds lost so much money. So if you're looking at TLT here, this is the ETF for the 20-year treasury, really 10-year, 30-year treasury, long duration treasuries. That's what this is showing you. Now, if Japan investors, money from Japan, theoretically gets sold out of our markets, that's going to be selling pressure on TLT. That's going to take the face value of TLT, the actual dollar amount of these bonds, down and drive yields higher. Would not surprise me if you did see this first rate hike from Japan really have a big impact on our markets. Sometimes these events can have big impacts. Sometimes they don't. Now, Japan's specifically a very important country because they own the most U.S. treasuries. Like, people think China owns the U.S. No, freaking Japan owns the U.S. Okay, take a look at how many treasuries Japan owns. They own like $400-500 billion more treasuries than China. Japan is the single largest owner of U.S. debt. A big reason for that is, of course, Japan has not moved the rates, at least higher, that is, in 17 years. Well, they're going to be doing that this week. At least it is widely expected that they will. So two fronts, this could be negative. Drive bond yields higher, maybe way higher, who knows exactly. Or the other consequence of this is drive yields somewhat higher, destabilize the bond market a little bit, drive bond prices down, and that's a problem for the banks that already have a lot of unrealized losses. And if bonds fall more, they're going to have more unrealized losses. Now, these two events alone, the Nvidia GTC conference and this rate hike from Japan, I think even before we get to the most important catalyst, which is Jerome Powell, markets are inevitably going to fall about 1.5% down to this 50-day moving average. I would expect to see a lot of support, that 50-day moving average, from the NASDAQ. Now, that would be at about 427 if you're looking at this on the triple Qs. Okay, so I expect some downside even before the Fed. Now, as I said on Friday, any which way you want to draw this trend line that we've been in, this bullish channel that we've been in, any which way you try to draw this line, you'll come to the same conclusion that on Friday you really broke trend with the decline that you've seen. You're no longer in a bullish uptrend in the NASDAQ. You are starting to curl lower. So if there was a time to put on a short, this was your confirmation, okay? I don't like technicals all the time because they don't tell you much until you break an uptrend or a downtrend, just to keep this simple. So you've broken to the downside. You've broken this uptrend. Now it's turned into a downtrend. This is the moment that you should identify as a trader and say, oh yeah, we could be looking at a lot more downside from here. And that's exactly what I'm expecting. Now, it's also pretty historical just how far away we are from our 200-day moving average. Right now, the NASDAQ is 11% higher than its 200-day moving average. Now, typically, you may look for like a 50% retracement from there. If we go ahead and throw some fibs on here, if you will, just to get back to like a 50% retracement, I mean, you're going to be somewhere around 415 on the triple Qs. And that's kind of what I would be expecting if I were you. I think that 100-day moving average is going to be important as well. That's at about 405, 406. Now, that's going to matter where the markets go based on the Fed. Now, I've talked about this in plenty of videos now, so I don't want to spend too much time on it. Let you guys get on with your day. It is St. Patty's Day, so shout out to you guys if you are here watching this video, getting ready for this upcoming week, because I think mentally you might have to just prepare yourself for this upcoming week. Now, in terms of the Fed is the biggest catalyst. As always, the report will come out at 2 p.m. This time's a little bit different because we will get a summary of economic projections coming out at 2 p.m. Eastern Standard Time as well. And then coming at 2:30, we will get Fed Jerome Powell. Now, the report that comes out at 2 p.m. will be important because you're going to get a change here to the dot plot. This is the dot plot from December 13th. It changes every 3-6 months whenever one comes out. I believe every 3 months. Doesn't matter too much. We're going to get a new one coming this Wednesday on March 20th. Now, from the September dot plot to December, the Fed expected a little bit lower GDP, the same for unemployment, a little bit lower for inflation, and a lot lower for the Fed funds rate. And this is really when the Fed started to get a lot more bullish or dovish on cutting rates in 2024. Basically, all your Fed members started to come out and say, we think we're at peak policy rate. We're going to be cutting rates anywhere from 2 to 3 times. That's what the last summary of economic projection said in December. Think about from July through December, what was happening with inflation. Inflation was falling each and every single month. Lots of progress happened on inflation during the time. Well, what's happened ever since December? Inflation has been rising. Every single inflation metric, whether it's PCE, PPI, or CPI, has come in hotter than expected for January and February. Likely it looks pretty hot for March as well so far. They take CPI specifically with 3 different readings throughout the month. And what we're seeing right now, some of the estimates are that CPI is still going to be high for March. Now, that's a little bit of a problem because, again, what has the Fed been saying the last couple of months? That they're at the peak for policy and that the next move is going to be a cut. I don't think they're going to deviate from that too much in terms of, I think they're going to say their base case is still for a cut. But I think the Fed, with the recent trend in inflation, they have to throw it out there that they will raise rates again. So I think there's going to be a lot less certainty on cutting rates the next time, right? Whether it's a cut or a raise, I think there's going to be a little bit less certainty there. I think the Fed's really going to revert back to the data, and I think the Fed's job right now is to get the markets prepared for another rate hike if they need to. And I've pointed this out many times, and I think it's good to do so. The Goldman Sachs Global Financial Conditions Index is at some of the loosest, positions we have been at since 2015, almost a decade ago. Even though the Fed has raised rates super aggressive, what do you have? You have stocks at all-time highs, cryptos at all-time highs, credit spreads that are incredibly narrow, right? You have all these other things. Capital is still flowing in the markets. Economy is doing well, presumably doing well. There's definitely no need to cut rates anytime soon. And I don't think the markets are widely expecting that. If you look at what's priced in, there's 2 to 3 rate cuts that are expected. Well, technically 3 rate cuts that are priced in for the December 18th Fed Fund futures contract. Do most of the markets think we're going to get 3 rate cuts at this point? Not really. Anyone I've heard says 1 or 2. The thing that really gives you this rug pull event that I think is going to happen is nobody's pricing in another rate hike. There is a 0% chance of another rate hike. In fact, the odds that the Fed does nothing this year, like doesn't raise rates, doesn't lower rates, is 1.2%. 1.2% out of 100. That's incredibly low. The odds of only 1 rate cut is 9.0%. I think the markets are really going to be asking, are we going to get another rate hike after this next Fed meeting coming this week? And think about the reason why this market has been rallying, okay? This market has been rallying in the face of declining rate cut expectations. We started 2024 and note why the markets were broadly rallying from October, November. It was because the markets had started to price in 7 rate cuts. At one point, back here on December 28th, as we started 2024, you were pricing in 7 rate cuts. Today, you're pricing in 3. What's happened? This is a chart of the percent of stocks above their 50-day moving average. What's happened? Well, stocks have been actually declining on a broad basis. Your big tech names, your AI stocks, they've really led the markets higher in 2024. Nvidia's conference, maybe that starts to retract some of that leading of semis. But the real reason why the markets have been rallying is not because 7 rate cuts or 5 or 4, the magical number. The number doesn't matter. The markets have been rallying so aggressively because the markets have said, well, the next move, if it's not a hike, then it's a cut from here. So the markets have been rallying based on the next move as a cut. If the Fed has to come out and, change that psychology and say, we might get a hike, that completely throws out the entire logic of why stocks have been rallying. Of course, the economy has done a little bit better than expected. Earnings have come in good, but still in the short term, the Fed's going to be the biggest driver of this market. So I do think after Wednesday, that's where you're going to be set up for a really rough Thursday, really rough end of the day on Wednesday, and probably a rough day on Friday as well. It wouldn't surprise me if we get a 4 or 5% decline in the markets coming on Thursday. Honestly, if the Fed is as, bearish as I think, that's going to be a problem. And again, aligning everything else that I've said here in this video, you're setting yourself up for an absolute freaking shit show this week. And that's going to be a big problem. Now, specifically with AMC, if the markets do fall, I think AMC falls. Now, good news is your stocks, as I showed you in this chart, only 51% of stocks are above their 50-day moving average. So I think the average stock will see less downside if we do go through like a correction or crash event. I think it's really your big tech. It's your areas that are not priced for another potential rate hike, right? Like big tech, AI stocks, semiconductors, they're not priced for another rate hike at all. Whereas your small, mid cap, interest rate sensitive names have already been getting beaten down in 2024. So I would expect some downside this week for AMC, maybe down to about $4 per share. That could be expected. But once you do ultimately bottom out, when the markets realize it's all going to be about the data. If the data comes in hot, the Fed's going to raise rates. If the data comes in light for inflation, the Fed might just hold rates for a while. Or they might start to cut rates if the economy gets worse. I think the data is going to become a lot more important than what we have seen recently. Recently, inflation comes in hot. Markets are green. That was the craziest thing. CPI came in hotter than expected, and the markets rallied over 1%. That's insane, okay? That's typically a moment where you're usually towards the peak of a rally. Correct me if I'm wrong, but that's just what I've seen in the past. So, expect some downside this week for AMC, maybe down to about $4 per share. But once things settle out, I think small and mid cap stocks, interest rate sensitive names are better priced for downside. So I think more bad news is priced into them. Of course. Could they fall? Yeah. But I think they will, have a less downside from here. And that's going to be interesting because a lot of hedge funds and institutions, they like to hedge their Nvidias, their Microsofts, their Apples, their Googles with small cap stocks. But if small caps have already fallen a lot, maybe that hedge is, well, wrong. And if that hedge is wrong and hedge funds and institutions start to lose a lot of money, they're going to hedge out their big tech stocks. And then what happens when they hedge out their big tech stocks? That causes them to fall. And then the already, news at coming Thursday and Friday from the Fed is already specifically bad for your leaders in the market. So I think you could, to some degree, get a snowball effect if the worst case bearish Fed scenario is realized. Could I be wrong with all of this? Could the Fed come out and say, yeah, we're not worried about the recent trends in inflation. The next move is likely a cut from here. Could they come out and say the same old bullish stuff that they have said before? Of course. But I think the odds are a lot higher this time that they're going to give us, to some degree, a rug pulling. Let me know what you think about this information down below in the comment section. Hit the like button as well as subscribe to the channel. You guys have a fantastic rest of your day, and I will see you in the next one.